You have done everything right. You found a great company, strong earnings, wide moat, clean balance sheet, and the chart looks amazing too. The price is sitting at a level of support, the trend is intact, and the momentum is building. So what do? You press the buy button. And the next thing you know, the stock drops. But it wasn't because that you were wrong about the business. It isn't because that the chart was bad. But it was because something else was happened entirely that you couldn't see. The entire market was in a state of panic, and when the crowd runs for the exit, even the best companies get dragged down with everyone else. And this is the third force which most retail investors never know it exists. So in this video, I'm going to break down sentiment analysis, what it is, how it works, and why understanding the emotional temperature of the market is the final piece that makes everything else we've covered in this series actually click. So you heard me talk about fundamentals, which is the what. Is this a good business? Is it profitable, growing, with strong competitive advantages and a healthy balance sheet? And the next thing we did was we covered technical analysis, the when, how to understand stock chart, what is the price telling us, where is the trend heading, and when might it turn. But here's the thing, even if the what is perfect and the when looks right, there is still a third question you have to ask, and that question is why? Why is the market moving the way it is? Why is the mood in the room so bad now? And is the crowd feeling greedy or feeling fearful right now? Because that mood, that collective emotions can override both your fundamentals and your technicals in the short term. And if you don't know how to read this, it will shake you out of your positions you should have held for a long term. So think about a restaurant, two identical restaurants, same menu, same food quality, but one has a queue out the door and the other is totally empty. Now, when you look at this, your instinct is to think that the one that has a queue has better food, right? Most people will join the queue, but isn't because that they have tasted the food before, but it is because the crowd's behavior signals that, hey, there is a queue here, so this must be better than the other store. So that feeling, that collective pull towards what everyone else seems to be doing, that is sentiments. And in markets, it works exactly the same way. So history provides us very clear lessons on the power of sentiments. So this is what you see during the dot-com bubble in the 2000s. This is a classic example because during this time, internet hype became so intense that companies with no revenue and no business plan saw their stock price double in a single day. The sentiments was so disconnected from the fundamentals earnings that a total collapse was inevitable once the buzz wore off. Now, the 2008 financial crisis showed the opposite extreme because as the housing market collapsed, panic caused a total withdrawal of buyers. Even shares in high quality, profitable companies were sold off without mercy in a blind rage of fear. And sentiments was so low that everyone, all investors, ignored the fact that some companies were actually still healthy in the long term. And most recently, this was back in COVID as well, when everyone thought that the world is going to end, everyone is going to stay home, COVID is going to last for the next 5 years, and its business is going to die. And at that peak, COVID was igniting so much fear in the market that it caused the stock market to crash by 30% in a matter of weeks. And that is what sentiment analysis is designed to do. So at its core, it is the measure of how all investors in the market are feeling about it, or even on a specific stock. So the fundamentals are the logic of the market, sentiment is the emotion. And here's what most beginner investors don't realize. It is that the markets are not a giant calculator. Most investors focus too much on the financials but forget that the market is made up of humans, me and you, right? So they are made up of millions of people making decisions every single day, not just on data, but on hope, fear, greed, and regret. Just take a look at this screenshot. This is a very classic screenshot of how a certain statement from someone can be misinterpreted into something else. I've got a stock here that could really excel, and suddenly people mistook excel as sell, and everyone starts to scream sell. And on the other hand, from everyone saying sell, 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 and then from someone that says goodbye, and everyone says goodbye, buy, and everyone goes and buy. This is exactly how the market works. And when this emotion starts to move together in the same direction, they can push prices far above or far below what the actual business is worth. But your instincts will also say, maybe I should run too. And suddenly everyone is running. That is crowd psychology, and it happens in the market every single day. Because when price starts rising, more people will jump in because they don't want to miss out. The fear of missing out, or in short for FOMO. That buying will push prices higher, which then attracts more buyer and continue pushing it higher. And this will continue until this euphoria becomes completely disconnected from reality. And then what happens next? It snaps. And the same thing works in reverse, because when prices start falling and fear starts to take over, people will sell. And it's not because that the business has changed, but it's because everyone else is selling. And the pain of watching your portfolio drop is too much to bear. And you read all the news and you also sell because everyone said that it's doomsday. Right? This is the feedback loop that drives bubbles and market crashes. And sentiment analysis is that tool that will help you to see where you are. Now, the natural question is, okay, how do we actually measure something as intangible as market emotions? Now, this is where it gets interesting. There are a few tools that we can use that the market looks at to quantify what is essentially a feeling, to give the best indicator of how everyone is feeling right now. Okay, there are 5 of them. The first one is the fear and greed index. I'll go through each one of them in the slides later on. The second is VIX, the volatility index. The third one is what we call investors survey. The fourth is a put and call ratio, looking at the options. And the last is social sentiment. The first one that you should know is the fear and greed index. So this is a signal that measures where the overall market sits on a spectrum from 0 to 100. So 0 refers to extreme fear, whereas 100 refers to extreme greed. So when the numbers is in the high 90s, what does it mean? It means that the crowd is super optimistic. Everyone is buying, everyone is super confident. And that is actually where you should start becoming more careful. Because when everyone is already in, who is left to buy? And when this number is on the opposite end, in deep fear, okay, at this area, it means that the crowd has panicked. People are selling regardless of value. And historically, that is where the best opportunities are quietly forming. The second one is the volatility index, or what we call the VIX. This is also known as the fear gauge. So the VIX measures how much price movement the market expects in the next 30 days. So when the VIX is high, it means volatility is very, very high. And it means investors are nervous and bracing for very wild swings. And conversely, when it is low, what does this signal? It signals complacency, because the market thinks that everything is calm, everything is stable. And often it is right before the VIX spikes that the unexpected happens, because complacency means people are not prepared. Take a look at how the VIX compares with the S&P chart right over here. So you can see that how when the VIX starts to rise, it actually coincides with market downturn, right? Because people are getting scared and waiting for the market downturn, and in return it causes people to feel fearful of what's going to happen and have increased volatility in the market, right? So this is one example, and this is another example during 2023 as well. We saw something similar. So you can see the inverse relationship between VIX and stock prices. When VIX is going up, stock prices usually comes down. Okay, and technical analysis can also be applied to VIX as well, based on the resistance or the support. So I've covered technical analysis in a separate video. I'll link it in the description box down below. Now, before I move on to the next 3 parts, since this is the final part of the series, if you have watched all 3 videos, the first one, the fundamentals, second one is technical, and you found them useful, there is a lot more where this came from. So I regularly share deep dives like this on markets, investing frameworks and mindset, and how to to think about building long-term wealth over in my blog. So it is completely free to subscribe, and when you do, you'll be the first to know whenever I publish something new. So the link is in the description box down below. It takes you about 10 seconds to sign up. And if you have made it to part 3 of this series, you are exactly the kind of investors that this content is made for. Now let's go on back to the video. So the third one is investor survey. So this is the AAII consumer survey. So these tools basically ask individual investors directly if they are feeling bullish, bearish, or neutral about the stock market in the next 6 months. So you can see this is the most recent data from the first week of April and the last 3 weeks of March over here, and you can see that the sentiment is very clear. More people are feeling very bearish about the market as compared to feeling very bullish. So this is a good indicator on how people are feeling as well. The fourth one are what we call put call ratio. So this is related to the options market. So in the options market, a call is a bet that the stock will go up, while a put is in a way a form of insurance that the stock will go down. And by looking at the ratio of put options to call options, we can see if investors are buying insurance because they are scared, or are they betting on growth because they are more confident. And you can see right now, where are we now on the put call ratio? It is currently up to 1, which is the highest in the past 20 years, which means investors are getting bearish about the market, because historically the put call option ratio is always at a low, as you can see, roughly below the 0.6 area, but it is at 1, okay, which means many people are buying put options now, and fear is becoming a little bit over exaggerated in this market now. And in the modern era, this is the last one, there is social sentiments. So what is social sentiments? Social sentiments are how people are feeling on social media. Okay, so social media, what do we mean by it? It is like platforms such as X or Reddit to measure how often a stock is being mentioned, or the stock market, and whether the language is positive, negative, is it more fearful, or is it more bullish. So this matters especially for retail driven momentum. And this was exactly what happened with GameStop back in 2021. And you saw how powerful decentralized retail sentiments can be when everyone rallies in and buy a certain stock, right? That is perfect sentiments at play, right? Then that move has nothing to do with fundamentals, nothing to do with the charts in any traditional sense. It was pure crowd emotions amplified by the internet. So this is the current sentiments on X right now. Okay, I got this from Grom. So what they did was they scanned through the overall sentiments on X now to see how people are feeling. And as you can see right now, bearish talks is getting louder and more headline grabbing in the short term. And right now it is dominating fear driven stress and getting quick traction during volatility. Okay, so you can see retail panic and crash chatter feels elevated, but the prevailing smart money narrative on the platform is contrarian bullish. Okay, so this is a very good. Right now AI can actually help us to do it very quickly, and you can sense that how people are feeling about the market. Everyone is still feeling bearish, but there are some sort of indication that the sentiment is turning bullish right now. And one of the most important concepts in all of sentiment analysis is what we call the overreaction principle. Now, markets almost never stay at fair value. Instead, they behave like a pendulum, right? Swinging past fair value in both directions. So fair value is right in the middle, and both directions can be at extreme fear or at extreme greed. And this key insight is that extreme sentiments is often a contrarian signal. Now, what do I mean by this? Okay, so you know that this extreme fear and extreme greed is basically where we get from the fear and greed index. And when the fear and greed index is at extreme greed, for example, most recently for silver, right, there was massive queues all around. That is not a signal for you to be aggressive, right? In fact, you should be running the other way, because when everyone is getting greedy, the fuel for the rally is gone. Everyone is really talking about it. There is no new buyers to push it higher, and the only move left is for the pendulum to go back to fair value and perhaps to the other way of extreme fear, which is the other side. Right? When markets are crashing, when the fear and greed index is at extreme fear, where every headline says that the world is ending, it is doomsday, that is exactly where you want to start paying close attention. Not because the pain is gone, not because that the bottom is in, we can never time the bottom perfectly, but because that level of fear, that point of maximum panic where people are selling everything just to make the pain stop, historically, that is where recoveries are born. Warren Buffett, one of the most legendary investors of all time, said it best. Be fearful when others are greedy, and be greedy when others are fearful. Now, most people hear this and they see this and they just nod. I got it, I get it. But I can tell you that very few people actually put this in practice. Because when the market is down 30% and the news sounds like it is catastrophic, the first human instinct is to run away from the fire and not to stay. And that is exactly why most investors underperform the market. It's not because they pick bad companies, but because sentiments put them out of good ones at exactly the wrong moment. Now, let me show you what I mean. And here is the data to prove it. Every single time when the fear and greed index has hit extreme fear, what happens to the S&P 500 in the 12 months that follow? So you can see for March 2009, 2020, 2022, April 2025, and this is where we are currently, 2026. You can see for the first 4 instances, 12 months after, the S&P gained at the lowest at least a 24% 12 months later. Right? So this research is very clear. Buying when we are at extreme fear has a high probability of you making money in the next 12 months. And there was only 3 data points across the entire data set that shows a negative returns. Okay, only 3 data points in this 14 years period, whereas every single time of the rest, it is always green from there. Right? So think about back in 2022 where tech stocks fell very, very hard. And one of the company, Meta, it dropped over 70% from its peak. Meta is a Mac 7 and it can drop 70% from its peak. So the sentiment was absolutely terrible. Everyone lost hope in the business. Everyone said that it is finished. But when you look at the fundamentals, it was telling us a very different story. Right? Meta had very strong cash flow, strong competitive advantage, and the users were still growing. Right? And the stock was broken, but the business was not. And investors who understood sentiments knew that the fear had become disconnected from the fundamentals. Now flip it around. What happens when we are at extreme greed? Now the results are messy. Sometimes the market corrects for weeks. Sometimes it keeps rising for months before anything happens. And the signal is inconsistent. Right, as you can see in Jan 2024, we did gain 12 months after, but it is just 13%. And when we look at Jan 2018, February 2020, November 2021, 12 months after, actually it was negative. Right? So that is the whole point when we look at both sides. Right? And this is the actual data showing what Warren Buffett said. Be fearful when everyone is greedy, and be greedy when everyone is fearful. Now, here's how to actually use sentiment analysis as part of your investing process. The goal is to never use it in isolation. Okay, you don't just buy a stock because the sentiment is fearful, and at the same time, you don't sell because the crowd is feeling greedy. You use it as a third filter layer on top of everything we have covered. Right, starting with fundamentals. Is it a good business? And then moving on to technicals. Is a price in a zone that makes sense? And last but not least is the sentiments. Because when fear is pushing down the price of a business that you have already done the research on, one that you really understand and have confidence in, that fear actually becomes useful information for you rather than a reason to panic. And when greed is pushing up the price of something that doesn't have the fundamentals to back it up, it is actually a warning signal, not a green light. And that is the contrarian edge that sentiment analysis give you. Now, the problem that most investors do is they operate with only one pillar, either fundamentals, either technicals, or sentiment analysis. right? Sometimes too. But I can tell you that the one who consistently build wealth over the long term are the ones who learn how to hold all three in their head at the same time, who buy great businesses at sensible prices when the crowd emotion gives them an edge. So it's not a complicated formula, but it requires patience and discipline. Right? It requires the kind of emotional self-awareness that most investors never develop after investing for so many years. Because the hardest sentiment to manage is not the market, it's not the business, right? It is actually your own sentiments. Knowing why you are making a decision to invest in this company, whether it's because your research supports it, or is it because you are just buying because of FOMO? Is that driving you? And that is the skill that separates investors who grow wealth from those who just chase the markets. That's what I have for you. We've come a long way from understanding what makes a great business to reading what the price is telling you to now understanding the emotional force that moves markets. And you now see what most retail investors never do. So if these 3-part series have added value to your journey, do hit the like and subscribe button. It will mean a lot to me and it helps me to reach more people who find value in this as well. So thank you and I'll see you in the next video.